Welcome to Microfinance Podcast, bringing microfinance to your screen. This episode is produced by MicroSave, together with ShoreCap Exchange.
For many institutions, I've found that they focus more on making the loans rather than managing the loans or the loan portfolio. That is why I think credit administration and credit controls are so important. When I say credit administration, what I mean is the organizational structure that you need to manage a loan portfolio. And when I use the term credit controls, I'm referring to the tools used to minimize the risk in a loan portfolio. In my years of working with financial institutions around the world, I find that oftentimes an institution looks at their individual loans rather than looking at the portfolio of loans. And they only realize this error in approach when their portfolio at risk goes beyond the acceptable limit of 3%. Far too often, institutions do not choose the right MIS, or they do not use their MIS in the right way. The principal functions of a credit administration unit are reporting and record keeping, monitoring the portfolio, compliance checking, and coordinating credit functions and credit staff. Every credit administration unit will need to be organized to fit the size and the business of the institution. Larger institutions will need a dedicated unit, whereas the smaller ones may only have a part-time person doing this job. There are 4 principal credit controls from my point of view, and those are reports, policies and procedures, limits, targets and quotas, and compliance checks. Many in my classes have expressed surprise that I have identified these 4 things as credit controls. They're so simple, they're so common. The real difference in making these credit controls is that you use them. You use the information generated, you measure and you monitor the data, and then you set an action plan and make sure that the actions are enforced. Credit administration and credit controls work best in a risk-aware institution, and this requires a major shift in attitude oftentimes in risk awareness, and this has to be a part of every employee, all the way from the guard at the front door who has to choose if someone should come in the bank, to the credit manager who is approving a loan, to the operations manager who is determining how to process a transaction.